overpriced stocks. When the decline happened, everything went fast. Not only did people lose money because they got hit with the margin call to return the money they borrowed, they also lost their jobs, their retirement wealth, which was, of course, invested in the stock market, and many people lost their minds. The second crash we will take a look at is the dot-com crash of the early 2000s. The dot-com bubble was based purely on speculation. The internet was that new shiny object everybody wanted a piece of. Everybody and their grandma tried setting up a website, then traded it on the secondary market through an IPO. Many of these companies could never make a profit or were mostly in the red, but people did not care. Websites were evaluated by how many clicks they received or how many eyeballs they could generate, instead of using traditional valuation methods like revenue and expenses. At the height of the bubble, everything came tumbling down like a house of cards. Many startup companies received millions in venture capital funds with the impossible task to get just as big, if not bigger, than the tech giants of those days like Microsoft, Apple, and Oracle. Chapter 5: How to Make Money in the Stock Market. So you want to make easy money in the stock market, but don't know where to start, how to take action, or you're trying to figure out how other successful investors are making money. We'll look at the two easiest ways investors have been able to get rich by investing in the stock market. Best of all, you can do it also. The two common ways investors make money in the stock market are with capital gains and dividends. Capital gains, explain. When you have your money invested in the stock market, the value of this asset goes up and down. When your money, also called your capital, increases in value, you have just received a capital gain. And when it decreases in value, it's called, you guessed it, a capital loss. As long as your money is invested in the stock market, it's unrealized. It only becomes realized once you sell your stocks. Let's look at an example. You decide to buy 100 Nike shares at around $65. Without factoring in trading fees, you ended up buying $6,500. This is also what your Nike stock capital is worth. A few days go by, and you decide to check on the stock's performance. You notice that the Nike stock price dropped from $65 to $61. So, your capital also dropped in value, from $6,500 to $6,100 to be exact. You lost $400, which is your capital loss. But you thought about this chapter and remembered that this is an unrealized capital loss because it is still parked in the stock market. You decide to wait it out, and after a few more days, the stock price increased back to $65, and you're happy that you're at break-even point. After a few days, it hits $72. You have just experienced your first unrealized capital gain and decide to share your Nike shares. You sell all your 100 shares at the current stock price of $72. So, you just received $7,200 in your cash account. Transfer fees not accounted for. By selling, you turned your unrealized gain into a realized capital gain. $7,200 minus $6,500 equals $700. You just made a quick $700 without doing any physical labor. Now, you still have to pay taxes on your capital gains depending on which type of investment account you are using and which income tax bracket you are in. This quick explanation is how many day and swing traders and even long-term investors make money. They analyze stock charts by looking at indicators and patterns to decide when to buy and sell stocks. You made a quick $700 with 100 Nike. But if you bought 1,000 shares, your profit would have been $7,000. If you have the money to spare, don't like taking any risk, and have idle time on your hands, you can make a pretty penny quickly by investing in the very risky penny stocks out there. Dividends. The second most common method investors make money is with dividends they received from dividend-paying stocks. Let's stick with the Nike stock example. So you bought 100 shares at $65. But instead of selling for a capital gain, you decided